we started the business, and even in construction projects, our initial line drawn in the sand was, hey, no recourse debt, right? We're just going to do non-recourse from debt funds and private equity groups, and if it's a couple of basis points more than 2% Fed interest rate, or 0% Fed interest rate, that's fine. We can pay.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Hemal Badiani is the founder and CEO of Exponential Equity. In case you didn't know, Hemal came back on the show. How long ago was that? January 4th, 2021. If you want to kind of go back and hear where he and his company was at that point in time in their journey, check that out. January 4th, 2021 is the date that episode published. That was episode number 36. Hemal, I don't know what this will be when this show comes out, but we'll be pushing probably 750 or 800 episodes thereabouts when this one goes live. So it was a while ago that we were here on the show. Appreciate you coming back on today. Hemal, if you don't mind, in 90 seconds or less, can you tell me, this is a question I ask every guest who comes on the show. Tell us, where did you start? Where are you now? And how did you get there?
Yeah, 90 seconds or less. That's great. So I started in the consulting world, and then from management consulting to banking to real estate and other businesses. Scaled over the last 2.5 years, portfolio from 0 to 150 million. 13 people in the team and the organization, Exponential Equity. And got there through sheer hard work, learning the process, hiring the right people, partnering with the right vendors, keeping myself humble, and really having authentic, credible conversations with an entire network of investors, partners, brokers, to get to know the game, understand it, and really work through it and pivot every 3 months to 6 months in these challenging times.
Pivot. It sounds like maybe your portfolio isn't comprised of a single asset class. Is that a fair statement then?
Absolutely, and will never be.
Okay. Tell us about that. What does that mean, and how have you effectively pivoted without getting distracted on the end goal, whatever that might be?
Yeah, so we kept an approach of we started in the COVID world with distressed assets, right? So in the COVID time, sellers were super scared. The debt market and the Feds were trying to flush money in, so there was money available from a capital standpoint to buy distressed assets on the cheap, and then turn them from a value add perspective to turn a profit around them. We successfully did that for quite a few assets. As 2021 kind of came in, we were like, hey, the things that are now getting pricey, the distress side is still there, but the sellers are not as scared. So there's a premium to be paid for those assets because of the free capital that was available in the market. So we decided to evaluate what other things we could do, and focusing around the market that we are in, which barbecue in our backyard in the Carolinas is amazing, and will be for the next 10 years or so. And so we decided, what else can we do? And we found that we know the street corners, we know the folks that are looking into the economic development and 5-year plans. And so construction industry meant to be the right pivot for us, and vertically integrated on that side to get that going. And then eventually got into the land side of the business as well, procuring land, raw land, to entitle it, rezone it, some of it to keep it for our construction projects, some of it to sell it off to other national developers, along with creating a property management entity and eventually a construction management entity. So creating a flywheel that revolves around, the 3-hour circle around Charlotte and the 6-8 great markets that are around Charlotte.
That is a lot of moving pieces. What has been your strategy for tacking on each of those as you went? Because I think maybe if you tried to do them all at once, it would just be overwhelming.
Yeah, my strategy has been super simple, and find the person who can run that business division first, and then tack it on. And so, Brandon Maxwell, our partner on the construction and land side, he had his own residential development company. He and I started chatting over beers one evening. He got inspired by the vision I had for what I wanted to do. And next week he sold his residential development company and joined us, right? And so when you have people like that that bring the competence, the expertise, you can learn anything given 5 years and 50 books on that subject and 50 networking events and all of that. But the price and from a timing perspective is too long. So if you want accelerated growth in any of these types of divisions or different asset classes, you have to put some learning into it. Obviously, you need to be armed and dangerous enough to know what you're doing, but you also have to partner with the right folks that allow you to accelerate that journey and bring those expertise in.
How do you know when you're bringing the right person on? I mean, because I understand exactly what you're saying and agree with that philosophy, but I would also wonder if you bring the wrong person on, say maybe in this case your partner Brandon Maxwell, it sounds like he's working out really great, but let's say
Yep.
found out in short order that it was a terrible fit. Like how do
Yep.
you avoid that pitfall?
Yeah, that's been 2 decades of consulting and banking. We've worked with a lot of people. As a leader, I have hired a lot of people. I've inspired a lot of people to enable their career growth. And what I like to say is I hire drill sergeants, so DRIL. They need to be driven. They need to be resilient because, hiccups and problem solving is the name of the game. They need to have super high integrity, and they need to be loyal, right? And so those four qualities are what I look for beyond their competence, right? Some people we hire that are brand new, that are just hungry and loyal and with high integrity, that you need to teach the business or some part of it that you're doing or a process. Some people are coming with high competency in a specific area as a subject matter expert, and they will also have a room in your team, right? So but regardless of the type of competence they bring or the type of industry they come from, as long as they're drill sergeants, I like to partner with them.
I like that. That's a great acronym there. So you went from multifamily to, and let me see if I get the iterations correct, multifamily to development to entitling land to what are you guys into now?
Yeah, so those three divisions are going in full swing, right? The beauty of those three division allows us to slow down or speed up any division without losing momentum from a company perspective, right? So 2021, in the first half of the year, as an example, we only bought a very small asset on the multifamily side, but we kickstarted 60 million in construction projects. And we bought and sold 150 acres of land. So that that those two divisions flourished while multifamily was slowing down. In the later half of the year, we bought 40 million in multifamily assets, because of where, again, the fear factor, be fearful when everyone's greedy, be greedy when everyone's fearful, factor kind of came in, and assets were kind of coming down in prices, reasonably priced, reasonable terms from a seller perspective. So we made a couple of moves in that phase, and then now we're looking at two things, right? We want to expand. We recently bought a fourth division of the business, specifically for capital purposes. It's called an EB5 regional center, that allows us to bring in foreign investments and foreign investors in, for job creation in the United States, specifically for construction projects, and that helps us with cheap capital. We can talk about that. And then we're looking at other asset classes, specifically hotel or triple net, as an expansion project. Again, once we find the person that can bring that expertise in terms of a division, that's when we'll make the move to start evaluating those projects. But in the meantime, we have four divisions of business that need quite a bit of attention in terms of management and working towards existing deals.
Well, and if you're one of the 30,000 people that listen to this show on a monthly basis and you fit that bill as a triple net and or what was the other division you're looking to build out? What was that person you're hunting?
Hotels.
Yeah, if that's your expertise, reach out to Hemal, certainly, and let him know, because it sounds like there's opportunity there to grow with a qualified team. So that's really, really cool. I want to hear about this EB5 regional center, if I even said that correctly. Can you break
Correct.
that down?
Yeah, and well, a topic in itself, but just a gist of it. EB5 is a job creation program by the United States immigration authorities. Essentially allows for every 10 jobs created in the construction space, directly or indirectly, to have an investor from outside of United States to invest in an entity here through the regional center for the most part, and with the high ticket 800,000 or $1 million per investor, and for the developer to keep that funds in for 4 or 5 years at a very cheap rate of capital, sometimes less than 1%, sometimes 2 or 3%, so super cheap. But on the investor side, the incentive is they get permanent residency of the United States after that as a family. So couple plus a family, kids under 18, up to 5 kids under 18 get permanent residency of the United States by investing in creating jobs in the United States. So it's primarily a job creation program. And by adding this center to our vertical integration, we as developers can partner with the center to procure those funds, help with the immigration side of the program, and then on the development side, create those jobs through build-to-rent communities and other things that we are building, and have super cheap capital, which is the name of the game with the high interest rates and other macroeconomic factors, allows us to compete in projects and be more profitable than most people can be.
Right, man. That is especially in the sky high interest. No, well, they're not sky high historically speaking. I shouldn't say that, but in the what we're used to higher interest rate environment, that's a fantastic way, really, to offset some of that cost of capital that other people are incurring. Did you acquire a regional center? Or are you building this from the ground up?
We acquired a center that's been around since 2013.
Okay.
It was run by two gentlemen. We bought a majority stake from one of them. And so basically we have one minority partner who had the experience again. And now we're, building it in an accelerated fashion by going to India and Middle East and, really pitching this as an avenue for people to kind of put their safe money into the United States. And as market turmoil increases, the amount of people that are looking for safe places to invest, such as the United States real estate,
Mhm.
becomes increasingly more. So it's a win-win situation for everybody involved in this.
Right, and it goes back to, again, I love the blueprint that you've set out for us here of finding people that already know what they're doing in that
Yep.
space. Like
Yep. Absolutely.
you don't have to know the nuances of how that business runs or operates or finds capital. Probably understand it from a 10,000-foot view,
Yeah.
but that's a fantastic way to grow on that front. Let's talk about the debt markets for a second as well, since we're talking about capital stacks. I mean, debt's on everybody's mind. This sounds like one solution that you guys are implementing in order to kind of bring your cost of capital down. What are some other creative things you guys are doing right now on the debt front?
Yeah, yeah, really, there are 2 or 3 things we've done in the past for all the projects over the last 6, 8 months that we had. One was, our initial when we started the business, and even in construction projects, our initial line drawn in the sand was, hey, no recourse debt, right? We're just going to do non-recourse from debt funds and private equity groups, and if it's a couple of basis points more, then 2% Fed interest rate, or 0% Fed interest rate, that's fine. We can pay 4 or 5%, but we're getting 75, 80% leverage. Now we're putting recourse and partial recourse on the table because
Mm.
we are confident on our projects, but recourse debt from local banks that we have created strategic relationships can come in at 5.5, 6% rather than the 8, 9% that non-recourse debt can come in. So there's a hefty spread between recourse and non-recourse.
Right.
Obviously, it puts a little bit more risk onto our bucket as key sponsors, but that's a risk we're willing to take because we are confident in the market that we are in. We know the streets, we know the projects that we're building from a long-term perspective, from a growth standpoint. So that's one. Second thing is really shopping the deal out. So we have a couple of brokers that, we used to be like, hey, there are 3 debt funds or private equity groups we made partnerships with, and they would pretty much get our pitch deck and OM and say, hey, can you fund this? Now for the last project, I think we went to 85 different lenders. to find and create a deal matrix to find the best source of debt, right? And you'll be surprised, right, how many people do things differently, right? So, well, somebody would be even floating rates. Some people do floating rates. Most people do it based on the SOFR, secured overnight funding rate. Some people do it on Wall Street Journal rate, which raises and rises differently based on the Fed's decision. So there are nuances that you can ink out, half a point, 1 point with different debt markets that you really need to understand, that we've gone and done a lot of research into. And so that allows us to have a very broad net. Every project, we have to go through that and make sure the terms are accurate. The third thing is seller finance, and the land projects. Every land project we've looked at, hey, seller, can we pay you later? And that allows us to have a 12-month to 18-month buffer at a very cheap 4 or 5% interest rate, rather than paying a bank or anyone else at 6-8%. So that's the other thing. And the fourth is what we talked about in the EB5 world, with cheaper capital from foreign investors kind of coming in.
That's awesome. I love that. How do you effectively shop a deal to 85 lenders?
Yeah, you hire a couple of badass mortgage brokers, and they do the work, create the nice little pitch deck for you from a lending perspective. And then you be ready to have, 5 or 6 different phone calls. The 85, out of the 85, there's 5 or 6 that come out that are really, really good. And then you negotiate the terms on, how many years, do you get paid for and penalized for an extension? Do you have any compliance? Do they lock your money in? There's 15 different things in the term sheet that we look for, and compare which has the best thing for us in terms of flexibility, and also cheaper rate short term, but also flexibility in the long term.
Got it. That's a lot of moving pieces. I love that. I'd love at some point to hear what those 15 things are that you guys look for. I'm sure they vary by deal depending on what the terms of the debt you need. Like, I'm sure on
Correct.
a land deal versus a build to rent community, it's probably different.
Correct.
Needs there on the debt front. But that's really, really fascinating. Tell me this, in a journey of the last 2.5 years, going from $0 to $150 million in assets under management, what's one thing, one misstep, one mistake maybe that you could help our listeners avoid that maybe you've experienced?
Yeah, the one thing, that the misstep I would say is, even though you might have momentum, because the market is such a shifting place, if you don't do the math and do conservative evaluation of every deal that comes to your table, right? Just because you close on a $20 million deal this month doesn't mean that in 60 days you'll be able to close even at $15 million deal.
Right.
It can get really, really hard, really, really fast. People's concept of money in a recessionary environment and where it's safe can be completely changed, drastically changed in a couple of months. So you have to be aware and be plugged in. You have to obviously use your momentum and wave each cycle to make sure that you're betting on the right things, but you also have to be aware of your investors' appetite, the macroeconomic environment, and sometimes it's very hard to do so when you have too strong a momentum going in, and you want to buy every piece of the great deal that's out there because it's discounted right now.
Right. Understood. Hemal, thank you for coming back on the show today. I certainly appreciate it. If our listeners want to get in touch with you and learn more about you, what is the best way to do that?
Yeah, they can reach us at exponential-equity.com. The email address is Hemal, Hemal, at exponential-equity.com. Love to have any conversation regarding real estate. This is what I breathe and eat.
Fantastic. Thank you again, Hemal. Have a great rest of your day.
You do the same. Thanks for inviting me, Sam.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.